I'm Rachel Horgan. Join me each episode as I sit down with a guest co-host covering the latest business stories in the Seattle area. We'll read the news so you don't have to. This is The Weekly. Okay, welcome. I am so excited to have a new co-host today. We're going to be rotating through different guest co-hosts. It'll be a mix of different journalists, executives in the Seattle area, some subject matter people that will share their opinions on what's going on in Seattle news. So my first, second guest is my former boss and friend, Emily Parkhurst. Hello, Emily.
Hi, Rachel.
It's good to see you. Emily has an impressive background I want to share with the listeners so they know how lucky they are to have you. You've been a reporter for many, many years. Then you were a reporter at the Puget Sound Business Journal, moving up into the editor-in-chief role, and then keep climbing that ladder up to the president and publisher of PSBJ at the age of 35. Very impressive. You then move over to be the VP of content at 6 a.m. City, which is, I would say, a daily email, more so lifestyle focused, right?
Yeah, exactly.
Yeah. And then on your free time, chairman of the board at the Cornish College of the Arts. So impressive background, very focused in the news for a long time, right?
Very focused. Almost 20 years, believe it or not.
Well, I'm excited to have you on. Do you care I know you left 6 a.m. City pretty recently. You always taught me to try and break news during events. So do you want to share where you're going next?
As much as I would love to share details, there are some exciting things cooking. I hope to be able to share them really, really soon, but I'm not ready just yet. All
right. I tried. Okay, well, let's get into the stories. We have some exciting stories here today. We're going to start with a lot of tech. I didn't do that on purpose. That's the way it goes. And then we'll end with a few stories on food. So I'm going to run through what those 6 are, and then we'll jump in with the first one. Sound good?
Great.
All right. So we're going to be talking about Expedia layoffs. I promise we won't talk about Expedia every episode. They just happened to make news last week. Microsoft has a new deal with an AI company. Techstars, which is a startup accelerator, closed. Rover gets acquired by a private equity firm. The FTC blocks Kroger's acquisition of another grocery store, and Burb's Burgers closes in Seattle. So that's what we're covering. Let's get started. Let's start with Expedia. Do you want to share a little bit about what happened over there?
Yeah, it sounds like Expedia did some layoffs this week, and it was really sad to see, although I can't say as though I'm super shocked to see it. We've seen a lot of tech layoffs this year. One of the tallies that I saw was 40,000 jobs in tech have gone away so far this year, and it's still February when we're recording this.
Yeah.
So it's been a tough start to the year. There's a lot of conversations about those being related to overhiring during the pandemic. I think we've all heard that quite a bit, as well as AI. And certainly Expedia pointed to both of those when they were talking about their layoffs this week.
Right. That's what I was going to ask you. Is we've got a lot of tech companies be like, "Oops, we hired too much during the pandemic because things were so successful, and now we're just right sizing." Which there could be some truth to that, as you're saying. The other thing you mentioned is people, and what Expedia says in their statement is we're just restructuring, which means we are focusing a lot more on AI. So these developers that don't have AI experience, they're out. We're bringing in this other department. Would you say that's right?
I think that's part of it. Expedia also is heavily reliant on airlines and travel, and that is still recovering. And certainly the issues with Boeing and with Alaska have a reverberating effect through that industry. And when you're so heavily reliant on airline travel, that's going to be a tough hit for Expedia as well. So as much as I would like to say it's completely an AI and an overhiring thing, I think it's also partially related to Expedia's business model.
Yeah, it could be a big mix. Do you think you're going to see more tech layoffs this year? Is this not the end of it?
It's not. Yeah. I mean, I hate to say that. That's such a downer.
I know.
But certainly, we've already seen quite a few in the Seattle area. I don't know about you, but I know a lot of people who've been affected by these layoffs. It's hard to live in this area and not know folks who have been affected by it. And it's a real thing. And it's going to reverberate through other industries that rely on tech for their own businesses. So I don't think it will be completely limited to tech. It's a little canary in the coal mine for if you want to lay into some cliches here. But I do think that that's a little bit what we're looking at.
Yeah, very cool. Anything else?
No, that was a depressing start to the podcast.
Yeah, I know.
Rachel, thanks for
that. Okay. Well, speaking of AI, so Microsoft signs a deal with a French company called Mistral AI. Now, why does that matter? Why is that a big deal? I would like to give a little background on this story, and then we can kind of dive into like what that means. But Microsoft has this partnership with a company called OpenAI. And if you've used ChatGPT, that is an OpenAI product. So when you think OpenAI, think ChatGPT. Microsoft has this partnership. They have 49% ownership, so they don't own it outright. And last November, what seemed like out of nowhere, the board at OpenAI ousts their CEO. They just kick him out. You're fired. Sam Altman, you have to leave. And he's like, okay, well, then I'm going to go work at Microsoft. A couple days later, announces he's working for Microsoft. CEO Satya Nadella hires him along with other executives. And then 500 employees of 700, by the way, so pretty much every employee signs this letter saying to the board, hey, if you don't get Sam back, we are leaving. We're going to Microsoft too, which I think was pretty impressive to see. And then Sam says, the board tries to get him back after all of this. And Sam says, okay, fine, I'll come back. But there was some sort of investigation. I didn't get a clear sense of why they ousted him. It seemed like more communication issues is what they're citing, but they're not really sharing too much. So that's the background on the drama between OpenAI and Microsoft. So tell us kind of what happens next with France's company.
I think what's interesting about what Microsoft's doing here is diversifying their AI holdings and relationships, and it's a really smart move. The quotes that I saw in the press were from Brad Smith, and anybody who lives here in Seattle and has interacted with Microsoft, I'm sure, is aware of Brad's relationship with the company over the years. He's their head of legal, and he's a really smart guy, and he has managed to keep Microsoft out of some regulatory issues. After those of us who've been here for a while remember when Microsoft was really deep into some regulatory issues, and Brad has done a fantastic job preventing that from coming back. I see this as them diversifying their relationships in the AI space, which is increasingly coming under regulatory scrutiny. And this is a really smart move for them. It's also international. That's another really smart move for them. And I think the smart thing here is to build out those relationships and that infrastructure across a lot of different AI companies. So when the regulatory pressure comes on, it's not just one. It's not just one company that will get hit. Yeah, it's multiple, and they'll be able to protect themselves a little bit better than if it's all in one sandbox.
Yeah, it's interesting because when I read this article, my first thought was, okay, they're signing this deal with this French company just in case things go south with OpenAI. They've got a backup company that they can rely on, which, I don't know, maybe there's some truth to that. But it's interesting to hear your perspective of, no, it's really more of a regulatory issue. And potentially maybe also what they said is true, is that they were just trying to get different AI companies, I don't know a lot about AI, but different layers of AI. And possibly that's all true too.
Well, for sure. And the conversation we were having moments ago about Expedia, doing some layoffs related to AI. I think there's also going to be a future of a lot of new jobs related to AI, and Microsoft wants to be a part of that. Mm-hmm. And it sounds like this organization in France is really far ahead. It's a great organization for them to be getting into a relationship with, and it'll help them plan for the future.
Okay. We'll keep an eye out and see what happens. Oh, we've got a closing of a company. I need to find some more upbeat stories because we've got 2 closes on this one, and I think we had 2 on the other one. But so Techstars, this one's, I'm glad that you're on for this one because you said that back in your reporting days, you reported on this company. So Techstars is a startup accelerator. So for those that don't know what that means, if you are a person, you have this idea, you want to start this company, you can pitch it to either an incubator, or you could also go into this accelerator program. So long story short, an incubator is more, I think, like you have this idea, it's a longer term that they stay with you, they provide resources, they help you with connections, they give you money, and eventually you have this product that you can hopefully sell. Accelerator, you're a little bit farther along, you already have this product, you enter into this 3-month intensive program that results in a demo day that you eventually hopefully get funding. So the Techstars that's closing is a Seattle accelerator, and some of the big name world companies came out of it, which you were just mentioning, which were they were
Remitly started within Techstars, as did Outreach, and then there's a company called Zipline, which I believe has moved to the Bay Area now, but started in the Techstars Seattle program. It's just, I think for me, I came here 14 years ago and was covering tech and startups then, and Techstars Seattle was in the early days of its heyday. And there were just such incredible people affiliated with that organization. And there were sort of the startup mafia of Seattle, right? We're all involved in Techstars. And I had the opportunity to spend some time with some of the Techstars companies and hang out in those spaces with them. Rachel, it was just like this great ecosystem of people, and they were sharing ideas and they were helping each other. And I think that's part of the value of the incubator systems, is that you don't just benefit from the people who are coming in who have done it, and of course that's a huge benefit. Right. You get the experienced entrepreneurs in there, but you're also sitting next to somebody who's working on a completely different problem, but probably encountering some of the same challenges that you are. And so it creates this kind of space. And I would say, I think folks who were following Techstars aren't totally shocked by this. I think they're disappointed.
Yeah.
And that's the what I've been seeing from folks in the startup community is just sadness and disappointment that we're losing this resource here in Seattle, and they've chosen to focus on areas where there's frankly more venture capital and more opportunity for the companies that are involved in Techstars, which from a business standpoint makes a certain amount of sense, right? Sure. That's follow the money. It's pretty basic. You're going to go to Silicon Valley, you're going to go to New York, you're going to go to LA. That makes sense.
Yeah.
But there's some amazing things happening in Seattle. And it's sad to see this particular resource go away. And I think that's, for a lot of folks in the startup community right now, a little bit what they're feeling. Yeah. That said, there's an amazing community here of startups and startup founders. Chris DeVore, who was affiliated with Techstars for a long time, has Founders Co-op. And if you're following this story, I'm sure you've read his missive about the death of Techstars in Seattle. But he's just one of so many incredible folks, Pioneer Square Labs, and a lot of great organizations here in town that support our startup community. And it's why it's as robust as it is.
Yeah.
And so we have a lot to be proud of here, but it is a kind of a sad departure.
Yeah, and just to get into the why they're closing, what I was reading is that they were low on funds to support this project, and so then they started relying on corporate sponsorships. So then they're going to different companies to fund them, to then fund the startup founders. And then that translates into you're serving these corporate sponsors, not necessarily the founders. You're doing things to provide ROI back to these corporate sponsorships rather than helping this startup founder come up with the best idea and putting resources into them.
And, I think anybody who's following this can kind of see the direct result of that. You just described it really well, Rachel. It's, when you're beholden to your corporate partners and your corporate sponsors and they're pulling the strings, they want very specific things, right? Yeah. They want opportunity for these companies that are spinning out of incubators to essentially buy their services, right? They wouldn't be involved if there was no ROI for them on the other end.
Yeah.
And it's a very different model than investors and venture capitalists.
Right, because the Techstars, what you were saying, their motto was give first approach. So basically give the founders a chance, whereas a corporate sponsor, they don't have an official motto, but the motto is probably like, give me money. So, I was kind of relating to this because I've started, besides this podcast, I've started a few other projects. And every time I start it, it's because I believe in it and I want to do it. And there's a demand for it and a need for it. And every time I tell my friends about it or whoever, their first question is, okay, well, how are you going to make money on that? I'm like, well, that's not the point. I'm just doing something because I think that there's a need for it. And eventually, if it makes money, great. And I know that's a kind of a naive approach to an actual startup company, but I liked that was kind of that mindset with Techstars.
Very much so. And certainly I don't want to discount the fact that the Techstars was looking to make money too. And
of course, yeah.
Certainly the VCs that were investing in these companies were as well. But that give first approach, there's something really special about that, about giving people a chance to figure it out. Because if you're only investing in the companies that you know are going to succeed, it's going to be the same people who get invested in over and over and over again. And we see enough of that. We see enough of that in the world.
Yeah.
I think one of the things that struck me immediately when I walked through that Techstars room the first time was the diversity of the people who were in that room. And I think you lose something when you stop focusing like that.
Yeah, very true. All right, moving on. Our fourth story, we've got 6 for you today. So our fourth one is Blackstone acquires Rover. So if you're in Seattle, you probably know Rover, but even if you're not in Seattle, you probably have heard of Rover. And that is the app/website that connects pet sitters to pet owners. It started in 2011 here in Seattle, and it just was acquired by Blackstone, which is a private equity firm, for $2.3 billion in an all-cash transaction. So this was announced in November. This isn't new information, but the deal did close last week. Aaron Easterly, he's the co-founder and CEO. He's still involved in this whole process, and he's excited about it. What else to say? Yeah, so I think that the conversation of private equity taking over companies is an interesting one and can be a long discussion. But I want to hear from you. Kind of, what do you think this means for Seattle? And is it a good thing? Is it a bad thing?
Well, Aaron should be excited. I'm sure he's shopping for very expensive houses right now. It's a great outcome for him, and so I think there's two pieces to this story. It's actually a really great story for Seattle. This is a great exit for an amazing Seattle company that was built here. Has a lot of really talented, smart people here who have contributed to its success and now are winning as a result. When you join a company like that, a lot of times you get equity in that company. And so there's a lot of people in Seattle who are benefiting from this exit. Yeah.
So we were talking about this earlier, when you say exit, for listeners that don't quite understand that, how does it actually benefit Seattle? So of course, people that had shares in that company, but who else would be benefiting?
Yeah. So essentially it's everybody who had shares in the company, and that's employees, executives in the company, as well as the investors. So Madrona Venture Group, for example, was an early investor in Rover and suddenly is getting a big cash infusion as a result of this sale. So what does that mean? Well, Madrona is a venture capital group. That means they're going to be able to take this money and reinvest it back into the Seattle startup community and find the next Rover. And that's exactly what an exit like this means. And it's really exciting. I think it also means that suddenly there's a bunch of people at Rover who have a little bit of cash, and maybe they do their own investing, or maybe they start their own companies. And so that's a really exciting thing, and it's what contributes to a really healthy startup ecosystem. Now, the flip side of that is this is a private equity firm. And anybody who knows anything about private equity firms is their job is to extract value from the companies that they acquire. And
so the CEO can be excited of, yes, we have a lot more funds now, we can do a lot more things. But that also comes with a loss of power and decision making. And so this firm can come in, and private equity firms kind of have this history of coming in and only caring about the bottom line, only caring about revenue, cutting costs everywhere, and kind of destroying a company. And then when it is destroyed, they just sell it off for parts. So, but that doesn't always happen. That's just some history that we've seen. So hopefully they can have a successful partnership and can just grow Rover.
Fingers crossed on that.
Fingers crossed. I wanted to ask you one question, just because at your previous job, we had talked about a big goal at 6 a.m. City was to be bought. Why is that important for companies to want to be bought? And how does it differ when it's an investment firm like Blackstone versus a different company like Microsoft or something like that?
Yeah, it's sort of the difference between a private equity firm and a strategic investor. And a strategic investor often is somebody in the industry or with an interest of taking what you built and merging it into their organization. So it's usually some sort of similar type of company. With a private equity firm, I mean, their job is to find the value and double down on that and extract as much as they possibly can, and then probably sell it, maybe even to a strategic. And so there's with private equity, it's a little bit of a different model than a venture capitalist, for example, and we don't have time to sort of drill into that. Right. But at the end of the day, the whole goal in selling an organization is that you want it to keep going. Yeah. Ideally, you don't want it to be sold off for parts. You want it to have the backing and the money to continue to expand. And these private equity firms have billions and billions and billions of dollars, and they can invest if they see an opportunity on the other side of it. And so it is possible that some of the business lines that Rover had that might have been struggling a little bit will get the love that they need in order to continue to grow. Sometimes that infusion of cash allows an expansion, and that can be really beneficial for the organization and for the customers. Yeah. Well, we'll see. The CEO does sound hopeful, and that does sound like his plan is to just grow the business. All right, 2 more stories for you. FTC, the Federal Trade Commission, blocks a
acquisition. So they file a lawsuit to block Kroger to acquire Albertsons. What does that mean? And who are they? So Kroger, if you are familiar with Fred Meyer and QFC, this is in Seattle, I should say. Kroger has Fred Meyer and QFC, and then Albertsons is Albertsons, Safeway, and Hagen. So basically, these giant grocery stores want to combine, and that will create pretty much a monopoly in the grocery industry. Not exactly, but pretty close to it, I would say. And so Kroger's argument is, hey, this is going to result in lower prices because that's what we do. And then FTC is saying, no, that's not what's going to happen. That's pretty much a monopoly. And that's when prices go higher because you can, because no one has a choice. What are your thoughts on this?
Yeah, this is such an interesting story. And we've seen a lot of consolidation within the grocery industry. It's a really tight margin industry, and it's why you see grocery stores sometimes turn over so quickly.
Right, meaning like if you're selling a $5 product, it costs them probably $4.50. They're making 50 cents. So a small margin, meaning they're not making much on each individual sale of an item, but their goal is to just sell a bunch of items to eventually make the money.
Yeah, and when you're comparing them to the companies we were talking about before, which are software as a service companies with recurring revenue, it's so much easier for them to make a massive profit. They can have 15 employees and make $50 million. It takes a lot of people, a lot of human capital to run a grocery store. So it's very expensive. I think the thing about the FTC blocking the deal, particularly in Seattle, it means a lot here. We have a lot of Kroger stores and we have a lot of Albertsons stores. And so what would likely have happened if this had been allowed to go through is they would have forced a divestiture, which means they would have forced them to sell some of the grocery stores here there were too many of them, basically. And what's likely to happen is they take a look at the books, they look at the most profitable grocery stores here, and they sell off the ones that are the least profitable. Of course they do, right? That makes sense. Well, it's going to be the areas of this community that are not maybe as financially well off that are going to see their grocery stores close. And so it can actually have a really negative impact on the community. Maybe heard of food deserts, areas where there's no access to healthy options for food. And that's when mergers like this can really hurt the community. And Seattle in particular would have been really significantly impacted by this deal because there are so many crossover stores.
Yeah. I was thinking about it in my own world. If anybody's listening in the event industry, as I am, I think that is starting to happen with the AV industry, audiovisual industry, as Encore continues to acquire more and more companies. They are such a huge part, have such a huge market share, and they can charge whatever they want. I've seen it firsthand. Love the people that work at Encore, but it can be really difficult because the event planners don't really have a choice. So I would be worried about that as a consumer at the grocery store, that they would just hike up prices because they can and we don't really have a choice. So it's good news is the FTC saved the day and is blocking this acquisition. All right, moving on to Burbs. Sad story. I don't know why I ended with this one. But chef and restaurateur Josh Henderson has closed 5 of his Burbs Burgers locations. He's known for starting and then selling Skillet Diner Chain. Have you been there?
Oh, yeah.
Yeah, I love it. Burbs, you may notice that was in the Quality Athletics space, which is down by the stadiums. And it also has a location in the Great Notion Brewing. We were just talking how we've both been there recently. And so they had 5 total locations. They opened up Burbs in 2020 in that Quality Athletics space. So that was their first one. And then he accumulated some debt with the pandemic. And he tried to counter that by opening up 4 more locations, but unfortunately just couldn't make up for the losses that he had. So he filed for bankruptcy in November. So I sort of saw this coming, unfortunately. Then days before closing last week, he did post on social media as kind of a last-ditch effort to try and get investors, but just couldn't get it. So I don't have a lot of discussion on this. I think it's just sad to see. Do you have any thoughts of kind of why this happened? Do you think we can blame this all on the pandemic or what?
Well, certainly, but I think the other piece is debt is just really expensive right now. And what that means, interest rates are really high. And it just means that you're having to spend so much money just making debt payments that it's really hard to keep a business going. And we were just talking about grocery stores being low margin. Try restaurants. Yeah. They're even lower margin. Mm-hmm. It's a really tough industry, especially in places like Seattle, where the cost of labor is really, really high. and there are a lot of regulatory hurdles in this city, and so it's a really challenging industry.
It reminded me of paying student loans, is that you like keep paying, but you're paying the interest for so long. And I imagine that's what some of the restaurants are going through.
That's exactly what they're looking at. And it's too bad because my family loved Burbs, and it was a great little spot.
Yeah, I just hope we don't see this continue as a trend with other restaurants in that they accumulated this debt, thought that they could get out of it by now. It's 2024, and I'm hoping that this isn't a time where people are shutting down the doors because they couldn't get out of it.
I would hate to see it, but I wouldn't be surprised.
Yeah.
And the pandemic was really hard on a lot of industries, but particularly restaurants. And I'm sure a lot of restaurants accumulated a lot of debt, and then debt got really expensive immediately afterward.
Yeah.
And that combination of things is really a 1-2 punch.
Yeah. Well, if you're a restaurant listening and you want to sponsor this podcast to help get more exposure, I'd be happy to help. Thank you, Emily. This was so fun. I love talking about the news with you. What a fun role reversal, too, because you used to choose all the news stories and talk about news, and now it's me. So this has been really fun. Thank you for coming on. And we'll see you next time.
Absolutely. Thanks for having me.
All right. This has been The Weekly. Make sure to check back next Sunday for the latest local business news. We love listener feedback, so if you have any story suggestions, comments, or complaints, email us at theweeklyseattle@gmail.com. We'll see you next time.